I'm here today with Cory Nickerson of 8Z Real Estate in Boulder, and we're excited to talk to you today about a topic that is near and dear to both of our hearts. But Cory, thanks for being here today.
Yeah, thank you, Gabe, for having me. As Gabe mentioned, I'm Cory Nickerson. I'm with 8Z Real Estate here in Boulder. I'm an associate broker, and I'm excited to share some ideas today that Gabe and I have talked about in the recent past. And yeah, we'll just spend a few minutes going through some scenarios that might help you if you've been affected by the Marshall Fire.
Yeah, so unfortunately, as we, as you've alluded to, this conversation today is really oriented around what we can do in the real estate industry to help serve our community. Both Cory and I live here in the community and have been impacted by the Marshall fires. And Cory, I'll just kick it off and really kind of get into the discussion today around how can we help individuals and clients that have been affected by the fire, and potentially what we're hearing, a lot of folks, somewhere between 50 and 65% of homeowners are underinsured.
Right.
So that's really what I wanted to chat with you about today, of how do we help those individuals?
Yeah, absolutely. One of the questions that I hear a lot from my sphere, my neighbors, my clients, and people in the community is, what am I going to do if I'm underinsured? And we read about it in the paper as well. Is I had $1 million home in Louisville. Overnight, I lost half my equity because my insurance company is only going to give me a check for $500,000. So, as a just easy numbers, could you maybe walk through how a reverse mortgage could help somebody that's in that type of situation? Starting
Sure.
with, of course, the age they would have to
Sure.
qualify.
Yeah, so Cory, again, just kind of talk through that scenario. So let's say somebody had a $1 million home, underinsured unfortunately, and for easy math, let's say they didn't have a mortgage, right? And they own the lot free and clear, and they end up with a $500,000 insurance check. It's going to be virtually impossible to rebuild $1 million home with $500,000, right? And under most insurance situations, and I can't speak for every insurance company in every situation, but in a lot of cases, the insurance company will give you a check to either rebuild the property or replace the property. And so what I think you're asking about is, if they take that $500,000 insurance check and they go to purchase a replacement property, right? How can they do that?
Right, exactly.
Right? And unfortunately, there's not a lot of $500,000 homes that many people are going to want to move into. So we've got a shortfall, right? So you've got a couple potentially that is accustomed to living in $1 million home with now $500,000 of insurance money or cash.
Right.
So the idea being that we look at a reverse mortgage or retirement mortgage strategy to say there's really two things that we want to come together and figure out how to make this solution work. So number one, we can convert that client, assuming they're at least 62 years of age or older, and in some cases as young as 55 years old. Okay? But let's just assume 62 years of age or older for now. They can purchase a home with roughly 50% as a down payment. Okay, and the older someone is, the lesser the down payment is required. But let's just, for easy math, assume based on their age that they can buy a home with about 50% as a down payment. So they can take that $500,000 of insurance money and go buy $1 million replacement home. And to close the gap of that other $500,000, we would utilize a home equity conversion mortgage or a reverse mortgage to finance the other $500,000. So the idea being that they have a $500,000 insurance check, $500,000 funded by a reverse mortgage, being able to buy a $1 million replacement property, and with the reverse mortgage, there's no required mortgage payments.
Right, and that's the important thing to touch on is, I want to talk about a few things with the reverse mortgage, but first and most importantly is that reverse mortgage requires no monthly payments, period.
That's correct. So on the money that's borrowed, i.e. in this scenario, $500,000 loan, there's no principal and interest payments or interest-only payments required to pay back that loan, as long as you're still living in the home as your primary residence, property taxes are paid current, and homeowners insurance and HOA dues
Yeah.
if there are any.
If there are
So those are going to be the same requirements
Right.
of any loan, quite candidly, or even if you don't have a mortgage, you're always going to be required to pay the property taxes.
Exactly, right.
So the only additional requirement in this case that I see with the reverse mortgage is you have to maintain it as your primary residence.
Right.
But as long as you're living in the home, you're right, there's no required mortgage payments.
So what if one of the, so you have a traditional couple, empty nesters, man and wife, let's just call it, that scenario. What if one's 62 and one's 59?
Yeah, not a problem.
Okay.
We can still do that. So
Okay.
again, under the typical FHA reverse mortgage, FHA being the Federal Housing Administration, only one of the borrowers
Okay.
needs to be 62 years of age.
And then what happens if down the line one of the older passes away before the spouse reaches 62?
Yeah, great question. And that was actually a big problem in the industry prior to 2014.
Okay.
Because the rules were such that in that case, the younger spouse would be considered what we call a non-borrowing spouse.
Okay.
Because they're not 62 at the time the mortgage was taken, they're not a borrower on the loan. But with the 2014 rule change, that non-borrowing spouse is now protected. They're actually written into the terms of the loan and recognized as a non-borrowing spouse as long as they are married to the borrower and are occupying the home as their principal residence. So in your question, if that older spouse passes away, the younger spouse, i.e. the non-borrowing spouse, has protections
Okay, great.
that they now have the ability to continue to live in the house for the rest of their life and not have to worry about making mortgage payments still.
Okay. And then some of the things I hear as an objection is, my kids, my heirs, for the estate planning, they're not going to get the equity in my home. Can you address how that works for the heirs?
Sure. So with a reverse mortgage, it's quite candidly from a title standpoint, the same as a regular mortgage. When you buy that house, and let's just say you buy $1 million house, and again, you put $500 down and you have a mortgage for $500,000. So you have a loan against the home, right? And until you pay that loan back, there is a lien on the property.
Right.
That's the same as a reverse mortgage or a traditional mortgage.
Right.
And you still have title to the home. So you have the right to sell the property at any time if you want. You could pay the loan off if you wanted to. And by the way, it might be feasible in this case where someone holds their lot in Louisville or Superior or Boulder County and eventually sells it and takes the proceeds from the sale and pay down part of or all of the reverse mortgage if they want.
Getting more equity back, taking the equity from the lot that burned and transferring it into the equity of the new replacement home as a potential.
As a
Okay.
potential solution, absolutely.
Okay.
But they could use it if they wanted to for a short-term loan or a bridge loan type of a thing until they sell the lot. But to your question, they're always going to maintain ownership of the house.
Right.
And they can pass that house on to their heirs. So to be very clear, you can still pass your home on to your heirs if that's important to you. The difference is simply that over time, that $500,000 mortgage balance, if you're not making payments, may grow because of the interest being deferred on the loan.
And the bank will get paid at the sale or the transfer of the title, if you do want to give it to your heirs, and the bank will then get paid the balance. But all the equity that's being built, and in Boulder County, we don't see anything but equity right now, and have for decades, if not longer.
Sure.
So your heirs, your kids, would still maintain all that equity.
Absolutely. And to your point, if you take $1 million house appreciating at 4%, which is a National Association...
pretty conservative here.
Pretty conservative, but we use that historically because that's
Yeah.
what National Association of Realtors sees nationally.
Yeah.
Not in Colorado
Right.
or Boulder County.
Right.
But $1 million house appreciating at 4% is $40,000 a year.
Right.
A $500,000 loan at 4% is $20,000 of interest.
Right.
Right?
So there's the math.
They're
the
still
math already.
making money, and the appreciation in the home is actually covering the interest, and the heirs in those illustrations are going to be just fine.
Yeah. And let's just say that,
Generally speaking, I can't say for certain,
of
but you know
course,
what I
but
mean.
generally, yeah, understood. If let's just say there is a market crash right as if you're an heir and you see that your parents are going to sell at a crash, and lo and behold, there is a depreciation. What would happen if it fell below the original value of the home?
Yeah, Great question. And that, because these loans are what we call non-recourse mortgages, that provides the protection, not just for the homeowner, but the heirs as well.
Okay.
So in that illustration, again, let's say you bought $1 million home, you took a reverse mortgage for $500,000, okay, and over time that $500,000 mortgage balance grew over time with the deferred interest. But in your question, if that $1 million home dropped in value, and now you owe more on the house than the house is worth, and you're what we call upside down,
Yeah.
as long as you're still alive, no harm, no foul. You can continue to live there without having to make mortgage payments, and the loan is not due and payable as long as you're living in the house and your taxes and insurance are current.
Right.
So you don't have to worry about being upside down in that example. But
Right.
if you were to pass away and your heirs inherit the home, but the loan balance, if in that case, is greater than the value of the home, because it's non-recourse, the heirs can't be held liable.
Cool.
Okay, for any amount greater than the value of the home. So in that case, they'd call you up, say, hey, Cory, unfortunately my parents passed away. I need to do a short sale. They seem to owe more on the house than the house is worth.
Right.
They can call you up. As a realtor, you can list the house, do a short sale, sell the house for fair market value, and the entire mortgage balance goes away to include that shortfall, if you will. And they have no recourse and no financial liability.
So no liability. Okay. This is my next question is, why isn't everybody doing this if you're over 62?
It's a great question, and I think unfortunately it's a complicated answer.
Yeah.
I think that my long answer short is because people are stuck in their minds that the way their parents did retirement is the way they should do retirement.
You had a great analogy about a paper map that I'd love to hear again for the benefit of our audience.
Yeah, well, when I was growing up, my dad, drove around in Southern California, LA County, with a Thomas guide.
Oh, sure.
And the Thomas guide, was LA County, and then if you went from LA County to Orange County or Riverside County, he had to pull out the other map book from the back seat. Right? And by the way, those Thomas guides and map books are still around.
Yeah, they are.
And they still work.
Yeah.
But they're not as efficient as, what we all carry in our pockets is our cell phone. And our cell phones, generally speaking nowadays, smartphones, have maps built into them to include traffic, right? And which reroutes you. And so the idea being that there's this concept of a paper map, it still works. But technology has changed, which has allowed us to drive about and navigate more efficiently.
Smarter.
And it's smarter. And I think that there's a lot of folks out there today that are in retirement or approaching retirement who have a mindset to say, well, this is how my parents did it. And a lot of cases, those folks today, they're looking at retirement in the face. Their parents were retired in the 80s. And in the 80s, when CD rates were in the teens, right, and they were earning a pension from their employer, right, that model of retirement doesn't exist today.
Even in the government, you're not seeing as many government pensions being able to fulfill their prior promises. Yeah, no,
that's right.
Yeah, it's a great way to look at retirement in a modern age.
It is, and so that's how people did retirement back then.
Yeah.
The way people do retirement today needs to be viewed differently.
Yeah.
It needs to have a paradigm shift, quite candidly, and a different way of viewing home equity. Because the other part about that is there's over $11 trillion of home equity in our country today in just the senior population. Okay? There's about $7 trillion. That's about $4 trillion less in all of the 401k money combined in our country.
Wow.
And I bet you don't put money into a 401k with the expectation of leaving it for your kids someday. But for some reason, people put money into their homes and expect it just to leave it.
Right.
And that's what I'm saying is the way we utilize home equity and the way we can utilize home equity with a home equity conversion mortgage is a much more efficient strategy to preserve and protect the other assets that you've worked so hard to accumulate and to save.
And I think that, I know I've had a lot of conversations with folks about almost apologizing for these past stigma of the reverse mortgage, and if you could just say a few words about or confirm what I've learned to believe, that the AARP not only endorses it, but I believe they started it, maybe, or started the concept of the reverse mortgage, maybe, that there were potentially there were some bad practices in the past, but a lot of that's been kind of cleaned up and reinvented.
Sure.
Do you want to say a couple words about that?
Sure. The AARP was definitely instrumental back in the 80s, and I would say President Reagan administration, along with the Housing Urban Development and with AARP support, to put this program into place in 1988. So the program has been around a long time. Now, with that being said, there's been a lot of revisions and changes to the program, which have made it a better and safer program.
Right.
As an example, there weren't caps on fees at one point in the program. So unfortunately, the mortgage industry, for lack of better terms, was able to charge excessive fees.
Some bad actors.
And there were some bad actors. That has now changed, and there are caps on the fees, just as an example. Right? We talked about the non-borrowing spouse rule that just changed in 2014. That wasn't that long ago.
Right.
So there were some problems with the program that, again, have had a lot of reform and a lot of changes that have made it a better, safer program. I'll share with you, I've been in the mortgage business 20 years now.
Yeah.
I haven't always loved reverse mortgages.
Okay.
It was only really in 2016 that I realized some of these changes, and I kind of wrapped my arms around the program to say, wow, this is not what I thought it was.
Right.
Having been in the business a long time, at that point, I didn't even realize some of the changes and how beneficial the program is. But once again, there's been some challenges historically. Most of it has been dealt with and cleaned up, and therefore it really is a new program. It's not the program that you think that it is.
That we've heard in the past. And,
Sure.
and I hope after this conversation, anybody who is finding themselves looking for alternative financing because they were a victim of the Marshall Fire, or even if not, just looking for some creative ways to tap the equity in your home, retire without a lot of stress in a modern world, as you mentioned. I'm hoping that this gives people a chance to just pause and think about, maybe there's a different way.
Yeah, I love it, Cory. Thank you.
Yeah,
and again,
thank you.
I think my pleasure. I really do love the conversation. I appreciate your time and you being here. And by all means, as you said, just providing the education and helping clients to know there are options out there. And it's really important to evaluate all of your options quite candidly. There's no cost, no obligation to sit down with you or me, and we'd love the opportunity. And if people want to talk with you, Cory, and about their options, what's the best way for them to get in touch with you?
Pretty much my cell phone or email is 303-961-6031, and I've got a really nice short email, Cory, Cory, @8z.com. So,
awesome.
Yeah.
Well, thank you, Cory. I appreciate
you so
it.
much.
And
Appreciate
look forward to
your
doing it again
time.
soon.
Thank you, Gabe.
All right.
Thank you, everybody.
Talk to you later.